All right, hey, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 15th of June. Welcome to the summer doldrums, right? I've got a couple things I'm going to go over tonight, including a couple questions that just came to me. But let's make sure we get going and make sure that we get everything answered. Over the last week, I had a lot of people talk to me about, what do I say? Talk to me about that collar trade some more. And it's funny because you'll hear me talk about sticking to your discipline, right? I do believe you need to stick to your discipline. But, sorry, wrong but. That doesn't mean you use hard, fast, and movable rules. I'm going to tell you more often than not, rules are for fools in the stock market. They'll make you look foolish. But a rule is different than a discipline. A discipline is a methodology or the idea that you trade. Let me go through a couple rules that absolutely bug the living crap out of me, right? A 20% return. I want to hit a bunch of singles. I'm going to get out at a 20% return. Well, I have learned, why wouldn't you follow technical analysis and let your winners run? Technical analysis is required to make your decisions. If you're going to go for a 20% run, then unfortunately, I might look at you and say, how can you not believe in technical analysis? Why would you not let a position run up to a level of resistance? Some arbitrage number doesn't make sense. The biggest mistake most people do when they spread trade is they don't include pivot points. They don't look at a 30-day average to see where stocks are moving. They ignore a 50 or a 200-day. They invent an 80 or a 100-day that not a damn person that trades any real money ever looks at. Why would you create a stupid rule that does nothing but contradict all your basic due diligence and, with all due respect, intelligence, right? Let some things run. There's nothing wrong with a 100% return, a 200% return. There's nothing wrong with following a position until it hits a pivot point resistance level, a standard resistance level, a horizontal resistance level, a simple moving average resistance level. Well, it could go back on you. You know what? Welcome to freaking markets. At no time are markets supposed to be easy. In fact, if the market doesn't make you uncomfortable, you're an idiot and you need to get your ass out of the market. Markets are going to make you uncomfortable unless you're paper trading, unless you're doing everything by theory, unless you don't have any money and you're a fake educator. Everyone asks me all the time, well, why have you liked Safe Option Strategies and Jeffrey Dunyan? Well, it's because he does some real trades. He won't do all of them. His portfolio is not big enough, but he does most of them. And it's interesting because some of the times he'll tell you guys to get out, but I know he's staying in them. I like seeing people tell you honestly what they're doing. So discipline and rules are completely different. It's okay to make as much money as possible in the stock market. Taxes matter in the stock market. That's why I like the collar trade. I always want to be in a stock position for at least a year and a day. Always. It doesn't matter. I always want to be in for a year and a day. It's a simple comment. I want to pay the 15% taxes on my gains. I don't want an earned income 33% tax rate. Anytime you hear someone say, I'm okay with paying more taxes, that's because you don't pay any damn taxes. Your earned income rate is probably 10%. Anytime you hear someone say that, well, you should be okay with paying more taxes if you're making more. Not when it takes away a third of your gains. Especially when you have state tax, it could take away 41% of your gains. You're an idiot, and you shouldn't be in the stock market if you're okay with paying more taxes. What a joke. You should just throw your money away if you're okay paying more taxes. Absolutely ridiculous. I know I'm on one today. Just bear with me is all I'm going to say. Just bear with me. But that's why I collar trade. I'm always looking to be in my stock positions for at least a year and a day. That's also why I like leaps, because you can hold on to option positions in a leap and also be in for long-term capital gains. So I want to change common rules to common practices on when to set up collar trades and so forth. Just an idea, right? So some simple ideas. I want protection when stocks are at their most volatile movements, i.e. earnings. Make sure I spell everything correctly. Oh, I can smell that barbecue outside. Oh, I'm a little hungry all of a sudden. At the money puts, I like to place 2 weeks to a week. Let's put it this way, 1 1/2 weeks before earnings. So let me give you an example why this is not a hard, fast rule. If I want to go 2 weeks before earnings, someone tell me, what am I trying to avoid? What am I trying to avoid if I'm going to put on my long puts 2 weeks before earnings? There you go. A couple of you put in here, volatility crush, right? That volatility increase in the price of your option. That volatility increase can really increase by 35%. You can see just that time volatility increase by 35%. So let me tell you a story about SanDisk. Well, for crying out loud, SanDisk was on a run. And they went from like 55 all the way up to 75. And when I sat there and I watched, I thought, man, I really should just let this thing run. But I kept rolling and rolling and rolling and rolling on a $20 movement. I basically still paid $5 for my puts, and I lost $10. So on a $20 movement up, I spent 15 of it for protection. How profitable do you think I'm going to be if I blew $15 out of the 20 by rolling puts up the 2 weeks before earnings and kept rolling and rolling and rolling as it went to a higher strike price? That's kind of a big fat, you just blew 75% of your potential profits. So I like to place 2 to 1.5 weeks before earnings. I love to place my long puts. But if I did that with Smith & Wesson Brands Incorporated now, I'm pretty sure I could have started off putting out those puts at around $13.78. When it's now up to where to close at $18.28. Well, Kevin, what if? I don't play a whole lot of what ifs. How about it seemed to be on a run? I almost put some puts on Friday. But if it has a pre-earning run, it does no good to spend $1 on puts at 13 when it's trading at 18 2 weeks later. Or 1, 2, 3, 4, 5, 6 days later. So I held off. But Kevin, you're going to spend, it's going to be 35% more. So let's do the math. Protect at 13, let's protect at 17. That's $4. If my $1 put is 35% more expensive, that's 35 cents. I can live with spending an extra 35 cents to protect $4 higher. Will I roll puts up higher again? Let's take a quick look. Smith & Wesson. $17 protective puts. Spent $2 and now we're at $1.55. Does it make sense to roll those up to $18? Spend 45 cents to make an extra dollar, 45 cents of volatility crush. Maybe. I might wait until Thursday when they have their earnings and roll it up to 20 if they're at $20 at that point in time. Kevin, it sounds like you have a lot of I don't knows. Well, actually, what really happens is every day the market changes. Every day the market moves. So you have to look at it with some longer term glasses on and decide if your single day movement will cause a change. How many times have you heard me tell you, more often than once, right? One day isn't a market trend. It just isn't. One day can be market movements. One day can move your portfolio significantly, but it is not a market trend. If we go and we take a peek, boy, I think the Dow had the one single worst down day ever, point-wise, on last Thursday. Gap down, opened up below the 200. Look at that. Awful. Horrific. A black swan event for sure. I mean, you can't look at that any other way and say, hey, that drop, serious black swan event. Let me bring you up to speed. To trade for the 1 day out of 1,000, or even the 1 day out of 500 now, means 499 days of the year you are overprotecting and overpaying for protection on stock ownership. If you want to protect for that horrific black swan event that could cost you 5% of your portfolio in a single day, I understand. Mathematically, I will kick your butt every single time because I'm not going to waste my profits in protection. It was ugly, but it's amazing how things are coming back. And yes, we started putting protection on. It'll be interesting because if I drop down to how I'm looking to trade, if I drop down to here, how am I looking to trade? I'm really going to focus on right here, taking profits. It's time, if we have an update tomorrow, which futures look pretty good, it's time to let some things run again to see if we can't add 100 shares on an Under Armour, to see if we can't lower our cost basis on a Disney, a Visa, an Apple, a Baidu. It'll be time to take profits, especially with the way futures look right now. All right, back to collar trades. When I start a new collar trade, I am willing to cap the upside. That's just giving people a level of comfort, right? But if the stock trades below the purchase price or the break even after you take a profit on your first puts and calls, I usually do not want to cap the upside potential. If I have a short call on, I am 99% of the time willing to lose the stock ownership. And if you want to know why, go back to last week's market commentary. So I'll show you how I want to convert those profits into leap options, a stock replacement, and really try to swing for the fences and make a ton of money. I am a believer in the Warren Buffett, underappreciated stock ownership mentality. I'm saying underappreciated, not undervalued. I probably should put an undervalued in there, right? But I started off with underappreciated. The reason why is because, in my not so humble opinion, most stock analysts are idiots. It's the only job that makes a weather reporter look smart, and that's being a stock analyst. More often than not, stocks are undervalued for whatever reason, but as they come across the boob tube and you see the people talking on the screen, it is underappreciated. They've got something wrong with it. Damn it, Apple is only a $700 billion market cap company with $100 billion in cash. Oh, they're an awful company. And Apple went through a 2-year downtrend with over $100 billion cash. I just kept picking up shares for people, picking up shares. 1,000 shares turned into 2,300 for some people. $100 billion cash. And they were thinking that Apple was all dried up. I didn't care if they sold another damn iPhone in the whole rest of the existence of the company. $100 billion of cash. Man, pile in to dump on Apple as much as you can, pile into back the truck up and dump them out of your portfolio, because I was picking up a ton of Apple. 4 years later, they're at what, 200 billion now? And if they don't make another iPhone, they will find money to make tens of billions through services and apps and movies. And my gosh, they're like the 7th biggest revenue generating country with cash on hand in the world. For a long time, Apple was underappreciated. Thought it was undervalued, and it was when it pulled back. But underappreciated stocks, if you do your fundamentals, are some of the best opportunities out there. What are some of those today? Well, they're Under Armour. It's Ford. It's Freeport-McMoRan. There's a couple that are really undervalued right now that have huge upside potential. Let's see. I like to know I won't see a stock lose 25% or more of its value at earnings. That's why I protect. I used to be a stock picker. I used to make great money and have it all wiped out by missing one stock. Benefits of collar trading? Simple. Dollar cost averaging without having to come up with more money to buy the shares. Man, it is so cool to use put profits to buy stock ownership. Strike prices, I think I told you, I like them at the money. I want the best bang for the buck. There are times I go out of the money, try to make my puts cheaper. There are times I go in the money, where I want to be protected more to the downside. Usually that is news driven. A gentleman emailed me some leaps. So let's take a look at some leap candidates. Roku, Microsoft, I love. I usually don't like doing an ETF, but a spider ETF or a spider fund like VOX or something like that, VOO, not bad. I would do that. I would not be in Chevron right now in a leap. I think Chevron or oil in general has a 3, 5 to 10-year lack of catalyst with oil being flooded onto the market. So I would not do a leap on Chevron. Again, Spider shares, Disney. I'm not sure what the VIX. I would never do a leap on the VIX. It's too fast moving. It is not a leap candidate. Apple, Merck, I mean, Dextron. For whatever reason, I would not be doing the Drexion shares ETF. I'm not even sure what that is, but I know that's not one that I would do. Going against Australia and Canada and so forth for their iShare ETFs, I would not be doing that as well as an ETF. Tesla, Berkshire Hathaway, I'd like, Invesco Trust. The Qs, yeah, you could do it on the Qs, makes sense. I would not do a daily technology, the ETF trust for the daily technology. In fact, is that what I missed up above? Trust, no. I wouldn't do leaps on funds. They're just not smart. Alibaba, I would do the Russell. Russell, in all honesty, if you look at a chart, there's some seasonal patterns that you would do it for a season, a 6-month period of time. Visa, Netflix, Facebook. I would not be doing the oil fund. Again, you have more than a 2-year time period for a catalyst there. Square, yeah, I don't know what ServiceNow is. I don't know Fastly. I wouldn't do the high yield. Any high yield, FOS, FES, any of those leveraged ETFs, very foolish. Very foolish. Not a smart idea to do a leap on. Treasury, again, I wouldn't do a leap on treasuries. I wouldn't do a leap on any short term. It's a short term for a reason. So any daily short term, ultra VIX shorts, not a chance. 3-to-1 leveraged, leaps are not your friend. Palo Alto, Twilio, Nvidia, yes, Johnson Johnson. I don't know the live long healthcare. Barclays, again, I wouldn't be doing it on bonds either. You'd overpay. So just a general idea of what I see for leaps. Leaps are not for leveraged funds. Or mutual funds. They are a cheap stock replacement for a company that might have explosive upside potential. And I know someone's going to say, well, Kevin, a leveraged and ultra 3 times, that is explosive, but it's built in. It's not a profitable position for a mutual fund, for a leveraged ETF, a 1, 2, 3 times, a daily. No. These are not profitable opportunities to use these leaps. All right, I've done a lot of ranting and raving. Let's get this finished up. Market cap, again, we had the single worst day in the Dow by points last week. I believe I got that from CNBC. With that said, as I took a quick peek at CNBC, it looks like year to date, we are down 5.08%. So not huge, but that one down day really was rough. A comment was just made, too much slippage in the leveraged funds. That is a perfect way to say what I was trying to say. So thank you for that comment. There is too much slippage in the leveraged funds that the options just won't catch up, and it's a very hard way to be profitable. So taking a peek at last week was down 4.8%. I think we were down 1.7%. Energies took a hit, financials took a hit, airlines are taking a hit. In fact, it's going to be very interesting. I'm going to show you a couple comments. No, a couple articles that are going to make you think. Where will the market end this week? I was going bullish. I'm going to stay with that. I think we do have a bullish week ahead as we bounce and fight the 200-day. The Dow has a 200-day fight, which means that we're looking at some volatility this week. The reason why I was going bullish really came down to we were so low on where I see managed money coming in. There was profit taking and rebalancing of funds. S&P looks just like the Dow, except for the fact that, yes, we are technically bullish, but this was even lower, bouncing off an oversold level on the Williams percent R. And I probably should be typing this in, right? Bullish, haven't had all of your crossovers, Kevin, but the MACD is crossed, but we haven't crossed yet on the the RSI. I get it. Same thing for the NASDAQ. I'm just thinking we're going to go a little bit higher for the week. Where we end June, I think we're going to be flat, meaning that when we're probably going to be at, right where we are right now. Wouldn't surprise me to see us go up to 3,200 again and back down to test, back down to have an issue or a problem. That issue or problem that I'm looking at is really nothing more than worldometer coronavirus. Are we going to have the spike, right? Are we going to have the spike that's going to be, for all intents and purposes, is going to be the market killer? Looking at the USA, we have plateaued, but we are not on the downside whatsoever. Kevin, how can you say that? We're plateauing. We do not have, in any way, shape, or form, lower highs. We do not have, in any way, shape, or form, lower lows. We are plateauing. I probably said at the end of May, maybe the middle of May, I said we probably have 6 to 8 weeks that will plateau and then we'll head down. We could head up. People going back to work, my state in Utah, we're spiking in cases. It's kind of ridiculous because we're spiking in cases and have 13,000? Not like we're 14,600. Ooh, that's a spike in cases, right? Compared to 405,000 New York, New Jersey 169, 156,000, Illinois 133. Yeah, we spiked from 10 to 14 in a month. Yeah, we're getting some more, but man, I've got it so easy, comparatively speaking, to other states in the United States. We just don't have the I don't know, we just don't have the amount of people that can just give it to each other. 2, 4, 6, 8, 10, 12, 13. So they're what? They're like 15 states. I'm in the lower third. I've got it easy. Yeah, maybe I'm more in the middle. 13, 15, 17, 19, 20. Yeah, we're in the lower 40 percentile, right? I've got it easy. I've got it easy, so it doesn't bother me, but I think we're going to have these knee-jerk reactions. We're going to have this volatility. I'm just looking for a flat June. Lennar Oracle for earnings on Tuesday. Wednesday, Carnival Cruise Lines, Kroger, and Smith & Wesson on Thursday. CarMax and Jabil on Friday. Really, retail sales will be huge tomorrow. I don't know why our futures are up 200 points, because retail sales is the most important economic report that we have coming out this week. It's all going to be how quickly is the market bouncing back? So that's going to be the question. How quickly will the market bounce back? And what will it do? But we're looking at volatility this week. That's why I'm close, but I'm not gonna, people ask, well, why didn't you take it off today, Kevin? You had some nice profits, and I still have some nice profits, but why didn't you take off your protection today? If anything, our market will tank like a stone if retail sales comes in worse than expected. And it's already worse. Retail sales tomorrow is expected to come in at possibly 9.0 or 5.2 ex auto. When it comes in flat or negative, you're going to see the markets tank. I am protected and did not take things off today because of a report that's going to come out tomorrow. And it's a pretty big report. It rules, for all intents and purposes, it rules what we're going to see. I'm just going to bring it up just to make sure, because it seems if I go over to my other economic calendar, you'll see this one is bright red for tomorrow. I mean, bright red. So red, I don't care about the Japan monetary policy. China's numbers don't matter. They're not controlling futures. What's going to matter? Fed Powell testifies, and where is it? Retail sales. Bright red. Big number. That's funny because I don't get it from there. I should just go from here. Because I think it's a lofty number. I think it's a real lofty number. Consensus says 9.0. Briefing says 7.5. Consensus says 5.2. Briefing says 4.5. I kind of think it's going to suck. I think it's going to suck. So because of that, it's going to be difficult. It's going to be difficult. The red means that it's an important. When it's bright red, it means it's stop and take notice of that report. A comment was just made. I haven't bought anything other than groceries. I know that we're saving money because I'm not spending a lot of money on gas, and I'm not spending a lot of money on fishing gear, camping stuff like my family normally does. We just haven't been there yet. So yes, it's a little bit of a quiet retail sales, but it'll be extremely important. Monthly options expiration on Friday. Amazing to see the Empire up today. It was supposed to be, well, I mean up, it's supposed to be a negative 25 and it came in a negative 0.2. Unbelievable. Looking to trade, looking to take profits on leaps, but I'm waiting for your retail sales numbers to come in. I thought it was hilarious. Hertz stock may look cheap, but Kramer cautions against buying it. When you're buying a penny stock, you're pretty much going to get what you deserve. Hertz says expect stockholders to lose all their money in filing for selling more stock. They are trying to get another $1 billion in selling their stock, yet they just told the people, hey, we're trying to cut that billion to 500 million, but you're probably going to lose every penny. Why the heck can't people figure it out? I don't get it. Once again, you just learned the smarts of the individual, or how dumb some people can be. The $100 billion convention industry is starting to reopen after a month-long coronavirus shutdown. Just something to pay attention to. I think with the spike, obviously this will be damaged, as well as hospitality, hotels. It's going to be big. It's going to be really big. I put this one in here because they talk about the Orange County Convention Center in Florida. There are quite a few out in Vegas, as well as California. Really interesting to see Vegas opened up a week ago, yet there hasn't been a lot of talk about all the people rushing back. Once again, U.S. Dr. Warren's recent uptick in virus cases says medical system might be stressed if people aren't careful. Here we have another report on there's going to be no beds for you, and if everyone gets coronavirus, they're not going to be able to take care of you. Kind of think it's hogwash, but I do have it in here. Something that's huge. The second biggest economy in the emerging economies, India, is now shut down. Second largest in population, the second largest emerging economy, and their economy is shut down. We're not through it yet. We're not past it. Great article to read. I always like Art Hogan. First market volatility is just starting. National Securities Art Hogan warns. Yes, we're going to probably go through our sell in May and go away, or we're going to call it our June gloom volatility. Probably flat now. We're really going to get hit in July and August, when obviously earnings is going to suck, but it's going to suck so bad that you're going to see people panic. If I was to ask this group, we basically just had a 35% increase from the lows. What's the retracement? What percentage of that is a retracement? What's the probabilities for the retracement? How much could our stock market go down in a probable, common, everyday, ordinary retracement? What percent could our stock market lose after we've just come up from that 35% run up? If you don't know, type in a question mark, but there you go. Lance, credit to Lance. You usually, when you have a big run up over 10%, over that 15% range, there's usually a 50% retracement. We could lose another 12.5% from the 5% we're already down, as people take their profits and the stock market looks attractive again. Most big runs up, bull market runs, shorter term bullish runs. I don't remember the exact number, but it's in that high 80s. 50% retracement is in the cards in the next 3 to 6 months. It would not surprise me, July, August, to see us back down 70% down for the year, 17.5%, before we start to find a buy bid again. And that comes nothing more than standard herd mentality. And it's kind of what makes the Elliott waves and the Fibonacci's somewhat work. I don't buy into either one of them, but common sense says people are going to take their profits. They're going to get the hell out of Dodge. All right, let's see what else I have for you. Brace for a gut check, summer sell-off. Investor Peter Bruckvar suggests just something to take a look, something to read through. Pretty interesting article. After big sell, stock market be wary of virus and Fed testimony a week ahead. That's just a little something that's going on this week for you guys to read. And then I have, wow, I think I like this article just because of their chart here. What's making it, what's not. Very interesting chart to see where retailers are making it. I forgot, but I thought it was 17.5% of retail stores are out of business, and 24% of restaurants are planned on not coming back. Small mom and pops have gotten beat up. And then I also had in here, well, I thought I had what's coming up this week. There it is. It's all part of the same thing. Just have some information here for you. Questions. What questions do you have for me? I know it's been a long one, but what questions do you guys have for me that I can get answered for you? Or what questions would you like to ask me that you just want an honest to goodness, truthful answer for? Yes, I'm on a plane flight in 2 weeks. So I guess I'm either foolish or not too worried about the COVID. I believe the week of July 5th through the 11th, Keeve and I are both going to need a week off, so we'll just send out pre-recorded market week commentaries out to you and trade findings and adjustments. I'm traveling the week before because that's a shortened holiday week. There's no Friday as 4th of July. No, market's not open on Friday. Plus, I just got to go visit a couple. Haven't seen him yet, and they took care enough to me to send me a bunch of statements that I've done some work on that I just want to go over and say, hey, let's get you into something better. All right. Hey, guys, have a wonderful evening. I don't see any questions coming in. I appreciate you being with me today. I hope this was helpful. I hope hearing the thought processes on what makes some real money. And I'm sure one of you has texted me a bunch of information there. So I was trying to make sure those texts were answered as well. But I will go back and answer those texts again. But I was making sure I got those texts answered so that you could hear it right from the markets, from the horse's mouth, right? Guys, have a good evening. Appreciate you being here tonight. Look forward to seeing you tomorrow for the trade findings and adjustments. Have a good evening. Be safe, and I'll see you tomorrow night. Bye-bye.